This is the 10-Minute Contrarian Podcast. This is VP. We are a solutions-based podcast, diving into the world of contrarian investing and alternative finance. You can find us hosted on the No Nonsense Forex YouTube channel, NoNonsenseForex.com, and podcast players everywhere. Episode 268 is brought to us by ByBit. You can hold and trade ETFs on ByBit. Not the 3 ETFs we're going to talk about today, but many of them. And the options just keep growing and growing. You can do just about anything you want on this platform. And you get crazy benefits on top of that just by clicking my link. Where's my link? It's down below in the show notes in the ByBit blog. Click the link to that blog, read the blog, make sure ByBit is for you. It will be. Unless you're an American, sorry. Then check out Apex Omni. But for everybody else, get on board, get enhanced customer service, which you never see on these platforms, and get yourself actively trading like millions around the world. You will soon discover what they have already discovered, and that is with ByBit membership. Has its rewards. It is a 10-Minute Contrarian Podcast, Sunday edition. These things just keep getting later and later. We will course correct soon here, I assure you. But this was kind of an impromptu episode because any chance I get to talk about ETFs and especially dividends, I am generally going to take. I don't feel like I do it often enough. I really enjoy talking about these things, and it seems like a lot of you enjoy it as well. So I try to shoehorn these episodes in when I can. Now, what's interesting is if you guys have heard me talk about ETFs before and dividends in the past, you know that I am not really, I don't want to say I'm not a hater at all. I'm just not generally a fan of covered call ETFs. So what covered calls do, I'm not going to explain covered call strategy here because I am not an options guy. I do understand it, but probably not enough to sit there and educate anybody else on it. But I do get the general gist of it. But these covered call ETFs will use this strategy to be able to extract some really crazy dividend yield percentages for their holders. Like pretty crazy high. If you want to go back to an episode we did called The Rule of 72, you can just simply look that up on the podcast player you use or on YouTube. You know that it doesn't take a super duper high percentage to double your account if you simply just leave it there and let it compound. And every little percentage point you can add to your overall take makes a really big difference. And now, I don't know how old you are. My age range on this podcast skews anywhere from teenagers to people in their 60s. And dividend structures appeal more to the older crowd, but stick around. I'm going to talk about the overall strategy for these towards the end, and I think this can be very, very appealing, even if you're younger. Remember, a good strategy is a good strategy no matter how old you are. Percentages are percentages, and they matter. And I'm seeing more and more younger, newer investors figuring this out, and that's really, really awesome. They're looking at their peers, taking way too much risk and getting it destroyed and saying, what would happen if I just didn't get my account destroyed all the time during my 20s? What would that look like? Well, it would actually look pretty great, especially if you had some real passive income going on in the meantime. I mean, so many of us could look back and just say, man, if I wasn't a complete idiot in my 20s with my money, where would I be now? And it's like, well, what if you just weren't that and you did things wisely? But anyway, what people really like about these covered call dividend ETFs is they just simply give you a much higher dividend than other ETFs do. It does come at a cost. We will talk about that. Now, I have never been a huge proponent of these because a lot of them are tied in a way to the success of the overall stock market. And because we've just been in this unfettered bull run ever since the great financial crisis, I mean, we've had a few hiccups in between, but nothing to really write home about. I have yet to see how well these things perform in a market crash. I have a hunch the majority of them should perform pretty poorly, like oh my God, poorly. But we just have not seen that yet. And you know what our ethos is here at the 10-Minute Contrarian Podcast. We like to hold things that will do well now while the market's doing really well, but also protect us and possibly go up when markets actually crash. Because in our lifetime, it's going to happen, contrarians. I know it doesn't seem like it sometimes, but The moment you think it's never going to happen is when it's going to happen. And so as far as things that pay me dividends, I'm like, I'm okay with taking less of a dividend if it means not getting my absolute face ripped off if we see a real market crash. I am just fine with that. However, the 3 dividend covered call ETFs we will be talking about today are not necessarily tied to the overall success of the stock market. They are more tied to things we like to track and invest in here. Things that are generally protectionary. Is that a word? Yes, it is now. Protectionary against a falling market, yet still tend to go up a lot. Which means we have, if we play this right, and we get in at or somewhat near bottoms, if these things drop a little bit, that's fine. They still pay out a ton. We can reap the benefits of this crazy dividend yield that you're about to see, while having that buffer, knowing that these things probably aren't going to go down a whole lot if they go down at all. We're buying these things when the underlying assets are closer to the bottoms than they are the tops. And I don't think you can say that about something like the S&P 500 or the NASDAQ. So as far as covered call ETFs go, I actually kind of F with these, even though I don't own any of them yet. I want to throw a disclaimer out there. I always say do your own research. I always tell you that I am not a financial advisor and not to do anything I say. I would like to stress both of those things very loudly. Do your own research. Don't sit there and say, if these things go sour, say, oh, VP, you neglected to mention this. And nope, not my job. Your job. My job is to simply point these things out and make a brief case as to why I like or don't like them. And remember, too, I am not an options guy. There will probably be intricacies here that I'm going to miss. But the point I'm bringing up here is that with these 3, they all are tied to things that can probably only go down so much more from here. Famous last words, I know, but you'll see where I'm going with this. But one more thing I want to point out, too, is all 3 of these instruments are very new, like barely a year old. So if you want to fast forward 1 year from here, they might look very different in terms of how well they track the underlying asset, how high they pay. Who knows? I'm just telling you what they pay now and what they have done so far, because I am pretty impressed with all 3 of these and what they have been able to do to date so far. And what's nice is all 3 of these pay a monthly dividend, which I do prefer as a chart guy, because let's say I want to exit one or I'm getting a sell signal on one of these. You can just simply do that without having to wait for the dividend first. But let's go ahead and get into these. The very first one is from a company called Curve, K-U-R-V. It is the Curve Gold Enhanced Income ETF, ticker symbol KGLD. And so far, in its very short history, this ETF has tracked the price of gold very well. Now, I ask you, contrarians, with gold sitting at just under $4,400 an ounce right now, after taking the drop it did after the run-up, how much lower could gold really go? Because when the price of these things do drop, you do make less money, because a percentage of less is less than a percentage of more. But at the dividend rate these things pay, and by the way, this thing pays a dividend of about 15%. Yes, you're getting a 15% return on what is more or less a gold investment. If this thing does drop, how much more could it really drop? It's gold, so probably not that much. And that's really nice, because this thing is paying you 15% year over year on average as you hold this thing. Now, remember, contrarians, on my cash, which is worse than gold, if I can get 3 to 4% yield on it, I am very interested. I'm doing that now in a lot of ways. But on something better than cash, much better than cash, to be able to get 15% on that? So I'm going to explain this again. Terrible cash, getting 3 to 4% on it. Everybody is on board with that. Awesome. Give it to me. And remember, the price of cash does go up and down too, mostly down. Yet everybody's lining up to get that 3 to 4%. Where on gold, which is way better and does nothing but go up over time, because it's measured against cash, which does nothing but go down over time, you're going to give me 15% on that? I know there's some drawbacks to these things, but hey, unless that drawback is equal to or worse than me waking up in the morning and having a Rottweiler bite me in the crotch, I feel like the benefits outweigh the drawbacks pretty well here. If I'm wrong, like I said, this podcast does go to YouTube. Please tell me how I'm wrong. Like I said, I know there's drawbacks here. For one, you cap your upside. This is something that your main reason for doing this is to get paid, not to cash in on the rise of gold. I mean, it's going to go up when gold goes up, just not as much as it would be if you just hold something like GLD, for example, or PHYS. But again, that's not the point of holding these things. You just want to get paid. And you can get paid on better money at 5 times the rate you would get paid on worse money. I know I'm kind of oversimplifying it here, but I'm honestly not oversimplifying it by much. I really like the idea of this. And when it's tied to something like gold and not the stock market, the chances of this thing completely blowing up in my face go way down. I mean, out of the 3 we're going to talk about today, this is by far my favorite. And your downside protection is even more protected the lower the price of gold is when you buy into this thing. It kind of sucks because there's so many things out there I want to buy right now. But man, this is intriguing, to say the least. Even with the uncertainty of this thing being fairly new, you're going to have to really come up with some crazy drawback to negate the advantage of getting paid 4 to 5 times the yield on better money. I just don't see it. But again, let me know if I'm wrong here, please, because we need to move on to the next one. Now, if you remember the episode we did on closed-end funds, I really like closed-end funds. I kind of hope the market does crash so I can scoop these things at values way below NAV and just hold them. And one of the categories in that closed-end fund world is probably, to me, the most intriguing one because it does offer protection against a falling market. And these are MLPs. MLP stands for Master Limited Partnership, and the real connotations behind that are not really important. Just know that when you're talking about MLPs, you're generally talking about energy, and you're mostly talking about oil. And the covered call, a dividend ETF I am referring to, in this case, is from NEOS, N-E-O-S. It is the NEOS MLP, an energy infrastructure high income ETF, ticker symbol MLPI. This one pays out just under 15% as well and pays you out monthly. Now, I asked this question before. I said, okay, given what's transpired so far, and I think I asked this question back when oil was in the 70s. It's in the low 80s now, I believe. And I'm like, how much lower can oil really go here? I know it probably could go down a bit more. But even if it does, with all the fundamental things that are going on in the world and all of the infrastructure that's been destroyed, it's not going to stay there. How could it? It's almost like saying these fundamentals don't matter at all. And I'm pretty sure they do. So when I look at downside protection, which you have to look at when talking about covered call ETFs, seems like we have some pretty good downside protection here. Even if oil gets back into the 70s, I would be much more interested in buying. We talked maybe 1 or 2 years ago here on the show. We talked about how it seemed like the United States and OPEC were a lot less adversarial and more kind of in cahoots with the idea that oil somewhere in the 60s was a pretty agreed upon level, to where everybody's making decent money, and we didn't have to worry about the price of oil getting out of control if we can just keep it there. So whether we get back there or not is not really a concern. What that tells me is that is kind of an agreed upon price to where they don't want oil to go any lower than that. Yet, if you can get the price of a barrel of oil down into the 60s, nobody is complaining. So barring something completely out of the ordinary, like we saw in 2020, which we'll probably never, ever see again, $60 appears to kind of be the floor here. And if I'm right about that, then this is plenty of downside protection for me. I'm just concerned about things completely, like the bottom falling out of things. And I just don't see that happening here. I can see it, like we said, with the S&P 500. But with with a commodity like oil, I feel a lot safer with this. Now, you're going to notice if you look at a chart that it doesn't really follow the price of oil to the letter, because what MLPI is an ETF that holds more midstream companies, refiners, carriers. And the true OGs out there might remember the episode we did on oil ETFs. There's different categories. There are ETFs which track the price of oil fairly closely, your producers, and then there's your, more midstream carrier types, which I actually like a lot better because they can still make money with low oil prices. And if you look at what's been going on in the war, what has been taken offline, what has been destroyed to the point where it's going to take years to get it back online, not oil producers, oil infrastructure. So the companies who remain standing, I think, are set up to do quite well in the next few years. And if you're concerned about the price of oil going up again, maybe a lot, then these things are just going to do even better. But again, remember, you don't get these things for the upside. The upside is nice if it's there, but you're getting these things because they pay you. You're really just more concerned about the downside protection, and I feel like there's a lot of it here given what I just explained. And if we ever do see a real downturn in the stock market, you're going to want to hold these things. The one instrument that does better than any other instrument in a crash is oil and oil stocks. Historically, this has always been the case. So again, it's like with KGLD. I'm trying to find reasons to talk me off of something like this, and there just doesn't seem to be enough. Does it bother me that these things are fairly new? Yeah, but what is the real downside here? We'll talk about the main downside towards the end here when we talk about the strategy. But I have one more to go, and there's a reason I saved this one for the end, because it is also from NEOS, and it is called the NEOS High Income Bitcoin ETF, ticker symbol BTCI. Now, if you ever think like NEOS is just like an unserious company and they're just playing around with things like this, Goldman Sachs doesn't think so because Goldman Sachs just bought NEOS. So take that news for whatever it's worth. But that's something that just happened like this past week. And I don't know what your thoughts are on the price of Bitcoin and where you think it might go. There are still some people out there who are very strongly with the idea that Bitcoin is going to drop down to 50,000, and that's when they're going to scoop some up. There are people who think it's going to zero. We here in Contrarian Land do not believe that. We think that Bitcoin is better money, just like gold is. It's just a more volatile version of that. I can tell you right now that big institutions are buying at these prices. Now, it's going to be a bit of a trade-off here. Bitcoin is more volatile. It could fall further than the price of oil or the price of gold for sure. But as compensation for this increased volatility, BTCI pays you an average of 26.5% year over year. Are you kidding me? Again, for better money. And as far as downside goes, get this. I actually talked about this on the show a while back. This is not the first time I have mentioned this ETF. This year, the price of Bitcoin has fallen about 28%. Now, if you're worried about downside protection and how well these things do when the asset falls, get this. The price of Bitcoin, again, fell 28% this year so far. The price of BTCI, if you factor in the dividends it's been paying you, has only dropped 25%. And now that's impressive. Again, you're paying me for better money, and you're paying me a lot. You're paying me 25%, Jesus. Remember, the prime objective for these cover-called ETFs is to get paid more, understanding that your upside is not going to be as much as it would be if you just held the underlying asset on its own. But the main thing we are really looking for here is downside protection. And with normal covered call ETFs, I don't feel great about it because we're closer to a top in the stock market than we are a bottom. But when it comes to gold, oil, and Bitcoin, I feel like, and I think you probably agree, that we are much closer to a midterm bottom than we are any kind of top. Now, I probably should have mentioned this earlier, but if you're not a United States citizen, how do you get access to these? Well, you can, actually. You don't have to wait for RWAs to come around. If you are a citizen of Canada, Australia, Singapore, Hong Kong, a lot of Asian and Latin American countries too, if you can access interactive brokers, you can get on board with these. Now, as somebody who uses interactive brokers to trade, not because I want to, but I more or less have to because that's the platform my prop firm uses, I was not really aware what you could do as a citizen of other countries on this thing. But, the more I meet digital nomads and, traders living in tax havens and getting the best of it, they all use interactive brokers and they have access to all of these things. So I know this isn't going to apply to all of you who are citizens of those countries, but take a look. I think doing a little bit of legwork up front is worth it to have access to all of these instruments, whether you want them or not. Options are good, and if some is good, more is better. Now, let's talk about the overall strategy here. If you are older and you just want to get paid, these things can be very good options for you. But if you are already making money that is putting food on the table and your earning days are not over, I feel like you should absolutely be reinvesting the dividends, using DRIP to reinvest the dividends and just growing and growing and growing the amount of shares you have with these instruments. Because if there should ever come a time where these things fail to perform their duties and pay you the dividends you expected, again, if it's paying you 15% and it drops to 12, how bad is that? You have to ask yourself. It's not bad at all. It's pretty great. But if it ever comes a time where it's just not doing what you want it to do, then you can just simply let it go. You're not married to these things. That's what a lot of these people in dividend world talk about. They're like, oh, it's risky because it might not pay you what it says it pays you now. Well, okay, that's not really a huge risk. A risk is me losing money, not simply getting paid a little bit less than I thought I was going to get paid. So if that's really the big concern of some of the people out there in dividend world, well, then just decide at what point is it no longer worth having. But if you just simply look at these things as instruments that pay you more for better money, whether that's gold or Bitcoin or even oil, remember, in the bond world, the difference between 3 and 4% is gigantic. Like people have gone to wars over things like that. Then the move from 3 to 4% to 15 to 25% is something you should be taking very seriously. Again, let me know what you think about this. Go to YouTube, go to the comment section, and let us know your thoughts. I'm just here to point these things out, even when I am not necessarily an expert on these things. And my overall expertise on covered call ETFs is probably as low as it's going to be when it comes to anything I talk about on this show. But on the surface, goddamn, are these things intriguing. So intriguing that it compelled me to make an episode about them. Now, if you ask your average investor about instruments like this and you tell them the return, the first thing they're going to do is shake their head and say, how crazy and foolish would you have to be to chase yields like that? But if the underlying asset for the three things I just talked about are at or near bottoms, then I don't think it's crazy at all. It is just us reaping the benefits, once again, by being early.